Healthcare is a huge business in the United States that is composed of a complex system of providers and payers. Expenditures surpassed $2.3 trillion in 2008, was expected to have reached 2.5 trillion in 2009, and is projected to reach 4.5 trillion and comprise 19.3% of GDP by 2019. The providers perform healthcare services and attempt to maximize the reimbursement received. The payers, conversely, pay out only what they deem necessary. Completion of this chapter, the learner will be able to define and manipulate the key elements of managerial cost accounting, identify and discuss the 5 steps of expenses, identify and describe the information required to calculate expected revenue, list potential intangible factors that should be assessed when performing a make versus buy analysis. Perform break-even analysis for a proposed new test. Price a new test. Evaluate the special considerations for capital equipment acquisition. Summarize the relationship between micro, departmental, and institutional financial analysis and examples of for-profit healthcare entities include the large commercial laboratories and some large hospital systems such as Columbia HCA or Community Health Systems. In a not-for-profit entity, profits are retained by the entity and used for purchase of capital equipment or other goods and services required to keep the entity in business. Levels of oversight of the financial side of a business. The first is management accounting. Management accounting. Private accounting performed by an entity for its own managerial activities, while public accounting, accounting that is made available to regulatory, government, and private accounting firms for both informational purposes and to meet regulatory requirements. It is important for managers to know what it costs to operate a laboratory section or department. It is the only side of the cost-revenue equation over which they have direct control. In order to perform the evaluations, the manager must have accurate records, including but not limited to test counts, vendor contracts, staff salary and benefit information, and consumable costs. Micro-costing accounts for all expenses associated with performing a given test, including reagents, consumables, laboratory costs, and reporting costs, and includes pre-analytical, analytical, and post-analytical expenses. It is a structured approach that, when built into a template, can be used to price any new test being considered or to be an ongoing evaluation tool for tests currently being performed. An alternative option that has found favor lately is cost per reportable contracts directly from the vendor. In a cost per reportable contract, the cost of the reagents and the equipment used to run the test is a set, predetermined amount contracted with a vendor for each test reported. For example, each potassium reportable test may result in the laboratory being charged 11 cents by the vendor. As in the traditional method of calculating test costs, the cost of calibrators and controls also needs to be considered and added to the cost per reportable to determine the total cost for each test. In either case, a large sample size should be used to determine accurate average volumes of tests, controls, repeats, proficiency tests, etc. Sometimes, when these numbers are very small, they can be included as a factor and not evaluated directly. All costs directly related to performing a test. Indirect expense includes expenses that are part of doing business but are not directly related to the cost of the test being evaluated. Cost may also be fixed, variable, or semi-variable. In medical laboratories, the charges billed for a test are attached to a specific CPT or current procedural terminology code. The CPT coding system is maintained by the CPT editorial board of the American Medical Association and is considered the standard for healthcare billing practices in the United States. Codes are assigned for all healthcare procedures, including operating room, imaging, respiratory therapy, and others, and are updated annually. From the statistics of the previous fiscal year and then modified based on expected or actual regulatory changes, growth projections related to strategic planning initiatives, and other factors that could have a decrease in volume. Generally, the hospital has a list of all billable services, their associated CPT code, and the price charged to the patient or insurance carrier. This list is called a Charge Description Master or CDM. The CDM is used to price inpatient and on-campus outpatient or regulated visits. The CDM is used for outreach business, which may be brought in to expand the hospital laboratory's revenue base. Although the CPTs are the same for the tests rendered, the charges usually differ. Both taxable and non-taxable entities may have one CDM, but may offer discounted pricing to other entities to which they provide services. This is possible because they are not billing the patient directly, but are billing the institution or organization who is purchasing the tests. The institution in turn bills the patient or other responsible party. Pricing for inpatient and outpatient procedures may be done using several methods. Pricing formulas, weighted value, RVUs, or the relative value units, performed by assigning an RVU to the test. RVUs are generally based on the complexity and time required to perform the test. The RVU is then multiplied by a fixed dollar amount to determine the pricing for the tests. Are key in evaluating real revenue as where a test is priced and what the expected reimbursement is. Determine how much revenue is actually generated. For inpatients, the need to control utilization is more important so that unnecessary tests are not performed for which the laboratory incurs expense but is not reimbursed. The break-even point is determined by dividing the fixed cost plus the dollar amount of the profit expected per test by the revenues generated minus the total variable expense. Figure 11-1, break-even point. In some cases, it is better to break even while managing to accommodate an intangible. than to make a large profit for profit's sake alone. Particularly in the community-based hospital, not all testing will be profitable. Comparing the expected number of tests to the number of tests required to balance the equation will indicate whether the test will be profitable. Although the increases and decreases may not be linear, it is prudent to keep in mind that these relationships do exist. Quantifying the relationships is generally possible given the availability of appropriate information. The astute manager also needs to remember that many things other than volumes can affect costs. Those include, but are not limited to, changes in method, changes in equipment, changes from manual to automated methods or vice versa, changes in test mix, changes in unit prices for laboratory, consumables, or purchased services, and changes in regulations. The degree of profitability should also be evaluated in light of a number of intangibles. This can be reviewed in the lab management text. Graphical representation of workload comparison between 2000 to 2004. As stated earlier, based on available resources, it must be determined whether equipment should be purchased, leased, or reagent rented. The issue of capital equipment lies in the current value of money. The outlay of a sum of money that has a current value but will increase in value over time, and if not spent today, will be more valuable in purchasing goods or services at a future date, is the center of discussion. Once spent, that money is no longer available and must be written off over the life of the equipment. If that money is spent in increments over a period of time, it has a greater total value over that time. Most hospitals use a straight line depreciation formula where the dollar value of the equipment is written off at the same rate over the useful lifetime of the instrument. That period of time is determined by the hospital's general accounting practices, but is typically the expected life cycle of the analyzer, which is usually 5 to 7 years. The calculation of the return on investment is another common practice when evaluating the cost versus rent or lease option. Profit margin and asset turnover, therefore, work in opposite directions. For the profit margin to increase, the turnover in assets must decrease. If a direct cost of a piece of equipment increases, the profitability of the testing scenario decreases. The goal is to at least break even on the return. Should also be made. This is critically important when cash flow is tight and capital funds are at a premium. When lump sum capital dollars are not available, a hospital can choose to lease an instrument. In a lease agreement, monthly payments are spread over a specified period of time and are based on the purchase price plus interest and taxes, insurance, and maintenance. Seeing that lease expenses can be depreciated, leasing can represent an advantage over purchasing when cash availability is an issue for the institution. Leasing also offers 100% financing at fixed rates, no money down, and protection for the laboratory against inflation. A second advantage to leasing is the equipment in the laboratory is more likely to remain current. The disadvantages of leasing include locking the laboratory into a long-term relationship with one vendor, lack of ownership, and higher reagent and consumable prices in most cases. Again, the advantage is that there are no capital costs for the laboratory, whereas direct purchase requires a large amount of money up front and leasing requires capital money spread over time. Reagent rental requires no capital money. If the allocated resources do not allow for lease or purchase, reagent rental can be used for the first year and equipment leased or purchased later, working with the financial services of the institution and appropriate vendors. If the choice is for a capital purchase of an instrument, it is important to realize the concept of the payback period. The payback is the number of years it will take to pay back the original instrument purchase costs. On cost accounting is available both in hard copy and in online and professional associations affiliated with the healthcare field. Examples: College of American Pathologists, Clinical Laboratory Management Association, Centers for Medicare and Medicaid Services. This lecture has presented a basic overview of the interrelationships of financial and managerial accounting, methods to evaluate expenses and revenues, issues surrounding reimbursement, methods for pricing tests, factors related to capital acquisitions, and a short list of resources available to laboratory managers. In an industry where competition is brutal and change is rapid and extensive, it becomes critical for the managers to understand and constantly evaluate the financial status of the laboratory. A strong knowledge of financial methods and practices will allow the manager to do that and to remain financially strong and competitive.